Nike dominated nearly every court, street, and screen on Earth, pulling in over $46 billion a year. Its empire felt untouchable, but beneath the swagger, a single decision cost them a fortune. A partnership they rejected handed $1.7 billion a year to their biggest rival and left executives scrambling to explain why. How did the world's most powerful brand make an $8 billion mistake that would shatter its own myth? The answer starts at their undisputed peak. Nike's reach stretches across continents, shaping not just sports, but entire cultures. In fiscal year 2012, the company reported $19 billion in revenue, a figure that would more than double over the next decade. By 2023, annual sales soared to $46.7 billion, outpacing rivals and cementing Nike as the world's most valuable athletic brand. More than 1,000 Nike stores operate worldwide, each one a beacon for millions of customers. The brand's share of the United States sneaker market climbed from about 28% in 2012 to roughly 35% by 2023, dominating both performance and lifestyle categories. Every year, Nike moves hundreds of millions of shoes, clothing items, and accessories through a network that spans 6 continents. Its supply chain supports factories in over 40 countries, fueling a retail empire that includes flagship stores in New York, Shanghai, London, and Tokyo. Franchise partners and direct-to-consumer channels push Nike's reach even further, generating billions in sales outside traditional retail. The numbers tell a story of relentless expansion. In just 12 months, Nike's sales can eclipse the entire annual revenue of some Fortune 500 companies. The company's valuation routinely places it among the world's most valuable consumer brands, with a global presence that few can rival. From high school gyms to Olympic stadiums, Nike's swoosh is everywhere, etched on shoes, jerseys, and billboards. Woven into the fabric of everyday life, this scale isn't just about selling shoes, it's about setting trends, shaping tastes, and influencing what athletes and fans wear from Boston to Beijing. Nike's dominance means that every decision, every product launch, every partnership carries weight. At this level, a single misstep can echo across markets, affecting billions in revenue, thousands of stores, and the habits of customers around the globe. Inside Nike's headquarters, confidence was more than a mood, it was a philosophy. Executives spoke of the brand's momentum as if it were gravity itself, pulling athletes, influencers, and entire industries into orbit. Analysts called Nike untouchable, praising its innovation pipeline and global reach. Magazine covers and business journals stacked up, each one echoing the same message. Nike could do no wrong. The company's leadership leaned into this narrative. They saw their track record as proof that bold bets would always pay off. Quarterly earnings calls became exercises in self-assurance, with top brass brushing aside competitor gains as temporary blips. When Wall Street questioned the risks of rapid expansion or the wisdom of chasing every trend, Nike's response was simple: trust the process. The swoosh, after all, was more than a logo, it was a symbol of winning. Intangible value became part of the balance sheet. Brand equity, cultural cachet, and the ability to set trends at will were assets that couldn't be measured in inventory or cash flow statements. Nike's leaders believed they could read the market's next move before anyone else. When a new celebrity or athlete partnership surfaced, the assumption was that success would follow simply because Nike's name was attached. Yet beneath the surface, signs of strain began to flicker. Some insiders quietly questioned whether the company's size made it harder to adapt, or if the relentless push for growth left little room for dissent. But in boardrooms lined with trophies and framed magazine covers, doubts were easy to ignore. The story of Nike was one of unbroken ascent, at least that's how it looked from the top. Nike's leadership drew a hard line when it came to intellectual property. Every contract, every partnership proposal passed through layers of legal review. The company's internal guidelines were clear: Nike owned the designs, the trademarks, and the stories behind every product. Royalties were reserved for the select few, mostly athletes, who fit the brand's vision of control. Celebrity collaborators, no matter how influential, rarely received a share of the profits beyond their initial fees. The board's rationale was simple: protect the swoosh at all costs. This approach was reinforced by policy documents circulated through executive channels, outlining a zero-royalty stance for non-athlete partners. Memos from dissenting voices, some from senior marketing staff, questioned whether this rigidity would limit Nike's ability to capture cultural trends outside the world of sports. Those warnings were quietly filed away, rarely discussed in public meetings. Meeting minutes from this period show a pattern. Proposals for shared ownership or creative royalties were routinely dismissed. Even as sneaker culture exploded and rival brands experimented with more flexible deals, Nike's governance rules held firm. The board viewed every negotiation through the lens of risk management, not collaboration. Protecting Nike's intellectual property meant keeping outsiders at arm's length, even if it meant missing out on new markets or creative breakthroughs. This mindset shaped how the company responded to requests from high-profile partners. When entertainers and designers asked for the same treatment as athletes, ongoing royalties, creative input, or a piece of the brand equity, Nike's answer was almost always no. The reasoning was spelled out in internal presentations. The brand, not the individual, drove demand. In the rare cases when dissent surfaced, such as in a 2012 memo from the lifestyle division, the response was swift. Executives reaffirmed the policy, warning that any deviation could dilute Nike's control over its image and product pipeline. By prioritizing ownership over partnership, Nike created a culture where innovation was measured by internal standards, not by the changing dynamics of the marketplace. The company's obsession with control became part of its DNA, setting up a silent clash between tradition and the demands of a new era. Whispers began to circulate among industry insiders, hinting at something unusual behind closed doors at Nike. The rumor traced back to a series of high-level meetings that were suddenly postponed, sometimes with little or no explanation. On more than one occasion, calendar records show key decision-makers arriving late or missing altogether, gaps that aligned with the periods when major partnership proposals were under review. Speculation grew as outside consultants noticed abrupt changes in meeting schedules, with some sessions rescheduled at the last minute and others canceled outright. Despite the persistent chatter, no formal complaints appeared in Nike's human resources files. External interviews with former staff and business partners offered only fragments, stories of a senior executive whose behavior became erratic during critical negotiation windows. Some described a pattern, missed calls, vague excuses, and a string of delayed responses when the stakes were highest. These anomalies began to raise questions not just about individual conduct, but about the judgment guiding Nike's most important strategic decisions. No direct evidence ever surfaced to confirm the substance abuse claims. There were no medical records, no official reprimands, and no whistleblower reports. The paper trail led only to unexplained absences and a handful of cryptic calendar entries. Yet the timing was hard to ignore. Each delay seemed to coincide with moments when Nike's future course was being set, whether to double down on control or open the door to new kinds of creative partnerships. The uncertainty left a gap in the official record, one that analysts and journalists struggled to fill. The lack of transparency fueled further speculation, casting a shadow over the rationale behind Nike's refusal to adapt its royalty policy. For those watching from the outside, the unanswered questions became part of the story, suggesting that personal issues at the top may have introduced risk into decisions that would shape the company for years to come. On November 25, 2013, an email landed in the inbox of Nike's legal department. It was short, direct, and impossible to misinterpret. The sender, a creator whose influence stretched far beyond music, outlined his final demands: a royalty percentage on every pair sold, creative control over future designs, and his name etched into the story of the product. The reply came just hours later. Nike's answer was no, not just to royalties, but to any suggestion that a non-athlete could hold sway over the swoosh. The exit letter was clinical, citing company policy and precedent, with a single line that would echo for years. "We appreciate your contributions, but cannot alter our compensation structure." Behind the scenes, the creators' team had already started talking to rivals. Adidas responded with everything Nike refused to consider: 15% in royalties, full creative input, and a promise to build a new brand around his vision. By December 3, 2013, the rival contract was signed. The ink was barely dry when word spread through industry circles. Nike's refusal was not just a missed opportunity, it was a statement that the company valued its rules over the person who helped redefine sneaker culture. The fallout began almost immediately. Investors called for explanations. Internal emails show a mix of disbelief and regret among those who had pushed for a compromise. Some in the marketing division warned that the brand was about to lose its grip on the next wave of cultural relevance. But at the highest level, the decision was locked in. Nike's leadership believed that giving ground on royalties would unravel decades of control. They saw the risk of setting a precedent as greater than the risk of losing a creator, no matter how influential. Within days, the creator's defection was public knowledge. Social media lit up with speculation and frustration. For Nike, the loss was more than financial. It was a blow to the company's image as the arbiter of cool. The refusal to adapt, made in a boardroom far from the streets, would echo through the industry for years. The creator, once a symbol of Nike's forward-thinking edge, became the architect of its most public mistake. On June 27, 2024, Nike's quarterly earnings report landed with the force of an earthquake. The company announced revenue of $12.6 billion for the fourth quarter, falling short of Wall Street's $12.9 billion expectation. But the numbers alone did not capture the shock. Executives slashed their guidance for the next quarter, warning of a potential 10% year-over-year decline. The news hit investors like a gut punch. Within hours, Nike's stock began to tumble, triggering a wave of automated selling across global exchanges. By the closing bell, shares had collapsed by 21%, the steepest single-day drop in Nike's history. With one earnings call, $26 billion in market value vanished from the ledger. The company's leadership faced a barrage of questions from analysts. Why had revenue stalled after years of steady growth? What did the guidance cut say about Nike's future? CEO John Donahoe and his team pointed to sluggish direct-to-consumer sales and a slowdown in digital channels. They cited inventory buildup and shifting consumer habits, but the explanations did little to calm the panic. The call's tone shifted from measured confidence to defensive urgency. Pressed for answers, executives struggled to reassure investors that the setbacks were temporary. The fallout extended far beyond the trading floor. Financial media ran headlines about Nike's lost decade and the end of an era. Social media lit up with speculation about missteps at the top. Inside the company, the executive team came under intense scrutiny. Emails from the investor relations desk overflowed with demands for clarity. Board members scheduled emergency meetings to assess the damage and chart a path forward. For years, Nike's leadership had projected invincibility. Now, with billions erased in a single day, that confidence looked fragile. The crisis was no longer hypothetical, it was unfolding in real time, with the world watching every move. The first wave of layoffs swept through Nike in December 2023. Nearly 1,600 employees lost their jobs as part of a sweeping $2 billion cost-cutting plan. For many, the news arrived without warning. An email, a closed-door meeting, a severance packet on a Friday afternoon. Some had spent decades with the company helping build the brand's global identity. Others were new hires, drawn by the promise of working for an industry leader. The impact rippled far beyond the headquarters in Beaverton. Families scrambled to adjust, and entire teams vanished overnight. Morale among those left behind plummeted. Internal surveys captured a sharp drop in confidence, with staff citing confusion over the company's direction and growing anxiety about further cuts. Nike's retail partners felt the shock too. As shelves once reserved for the swoosh began to shrink, rival brands filled the gaps. In major sporting goods chains, store managers received new planograms that pulled Nike displays from their usual prominence. By spring 2024, the reallocation was visible, with more Hoka, more On-Running, and fewer Nike boxes stacked by the entrance. Wholesale buyers, once eager to secure early shipments, now questioned whether Nike's dominance could be taken for granted. The decisions made in distant boardrooms translated into real consequences: lost jobs, frayed partnerships, and a brand no longer invincible. The number, $8 billion, hangs over every debate about Nike's recent turmoil. But the truth behind that headline is far less clear-cut. No official accounting statement lists an $8 billion write-down. There is no single line in the annual report, no footnote that ties a bow on the loss. Instead, the figure comes from a patchwork of missed opportunities, eroded market share, and the staggering cost of reversing course. In March 2025, Nike's board approved a major strategy shift, walking back years of betting on direct-to-consumer sales and digital-first growth. The company's leadership turned over, with new faces brought in to repair relationships with wholesale partners and rebuild the innovation pipeline. Yet, even as executives recalibrated, analysts struggled to pin down the real cost of the mistake. Was it the billions in lost sales to rivals, the stock value erased in a single day, or the years spent chasing a vision that no longer fit the market? The accounting is murky, the damage spread across quarters and categories. What is certain is that the board's decisions and their reluctance to admit error left investors and employees searching for answers that may never come. For global brands, a single decision can redraw the competitive map, often in ways no one predicts until it's too late. In a world where rivals can gain billions from one misstep, Every negotiation now echoes louder. The stakes aren't just profit, they are cultural relevance. Today, the margin for error has never been thinner. What would your brand risk for tomorrow's edge? Share your thoughts below.